And hello traders, and welcome to the second part of the PDF guide. So guys, in the last part we stopped when we finished all about supply and demand concepts. So again guys, if something was not clear to you from the first part, again, you have our Discord community and we are open to any questions. So if you have any concerns or something is not clear to you, go ahead and ask us a question in community. We are here for that, basically to reply to you, to help you out, to guide you, etc., etc. So do not be shy. If you have any questions, something is not clear to you, just go ahead and ask. We are there for you. Okay, so with that out of the way, guys, we are going to move forward. And in front of me, I have the lesson that it's called premium and discount pricing. So a lot of you guys probably know about this concept. Maybe some of you guys heard it for the first time. So I'm gonna explain to you what that means. Before we go on, again, I want to make sure that you have first read and go through the whole PDF before you start watching these videos. Because again, guys, you need to study all of this before you can watch these videos, because when you watch the videos, it's going to be, really better. If you start watching it and you didn't go through it and you didn't, study it, it's gonna be a little bit messy. Something's not gonna be clear to you, because I'm not gonna read everything that I have wrote here. Okay, so it is way better to just go through the PDF, study it, and then watch all of these videos. So in front of me we have premium and discount pricing. Basically, it's you knowing where you're buying and selling. You do not want to sell and buy in bad prices. You always want to get involved in the best prices as possible. Okay, so in front of me I have example of bearish trend going to the downside. Okay, so as you guys can see, we had this impulse downside. We created this new lower low. Price was retracing, again broken down. We had this momentum. We had one little bit of retracing this momentum, and we have two legs to the downside. And we had a retrace here, and we broke the high here. Right now, guys, when you're calculating, your premium and discount zones, you're always marking your higher high here. Lower high, and lower low. Okay, so you can use a Fibonacci tool for knowing exactly where is your premium zone, where's equilibrium zone, where's discount zone. It's better to do it that way. Or if you have access to our indicator, you can just turn on the premium and discount, and it's gonna be already automatically done for you. But if you do not want to use, for example, that option, you can go ahead and use the Fibonacci tool, and it's gonna also give you a precise, details on where the zones are. So basically, guys, here in this price, it's not that good to sell. Okay, so in equilibrium, I like to trade in equilibrium. This is like my middle zone that I love to take trades from. And this is what people, smart money traders, call extreme. This zone is extreme, and usually smart money traders like to execute from extreme because they're looking at this as a liquidity, or maybe they have imbalance here, and then for them it's safer to execute from here. But I like to execute way more this equilibrium ones trades. But again, when there is a momentum involved in the market, if I see a weakness to the downside and if I see a strong push to the upside, of course I'm not going to trade from equilibrium. Then I'm going to wait for extreme. But I do love to execute when there is a momentum from the equilibrium zone. So basically, it all depends on what kind of price action we are seeing. If this bit of price action is like this, when you have price breaking above, and then reacting to this order block and continue to go to the upside, then we have here a little bit weakness in form of this ascending price action. We're using this zone that we have right here as a reaction zone. Of course, we just do not want to execute blindly. It's never a good idea. I'm seeing traders just marking randomly, their order blocks, and they're straight thing executing from them. It's never a good idea. You always want to see a reaction. It's gonna build a little bit more confidence in your analysis. And then, as you guys can see, after the reaction, when we use this order block as a reaction, we can basically test it out. If we see a reaction input to downside, you know that price is most likely going to continue to downside. If price just melts to this order block, continues to the upside, you save yourself from a loss. So we're waiting for reaction here. We broke to the downside. As you guys can see, we had a demand zone right here. That's called a flip. Okay, that demand zone has failed. We have change of character, reversal trade. This is our execution zone on this new order block, and price continues to the downside. It's going to be more cleaner when I show you a chart example, with candles. But again, this is the concept. Okay, so here, guys, you do not want to sell when price is in a downtrend. You do not want to sell in this zone because it's too quick. Price usually retraces a lot. When you have impulse, correction, impulse, price is usually retracing to almost 50% of that impulse. Okay, not every time, of course, but it's rarely gonna retrace here and then continue. Okay, we usually expect to see a little bit more a pullback, especially if you have imbalances right here. So basically, you want to sell in equilibrium or in this bit of price action in premium. Okay, you do not want to execute here. It's gonna be a little bit, not good entry point. And if price action starts to show you a rejection and reaction in equilibrium or premium zone, this is where you want to take your trades from. Okay, so let's go and see the chart example right here, guys. Again, this is basically the same example, as here. So price was going in the downtrend, as you guys can see. Here is the premium zone. This is where smart money traders love to take trades from. I do not necessarily like to trade from extreme always. It depends on the price action, of course. We had, we were putting in lower lows in the market. Guys, we have here the lower low. We have here lower high. This is basically momentum. You're drawing from here, from the lower high. You're drawing all the way to lower low, and you're basically seeing where is the 50%. 50% was right here. So this was a good price. This was a bad price. Price action was reacting, change of character, reacting to the upside, a little bit of more of momentum here. And then we start to see a couple of retraces here. Price broke to downside, continue, made a flip, as you guys can see, shifting momentum, imbalance to be filled, and then reacted from this zone, newly created zone, and we continue to the downside. So as again, you're basically better off, trading this and using this supply as a reaction. You do not want to go straight and execute the trades based on this zone or whatever. It's always better to see and wait for reaction. If you have a reaction, that means that most likely price is going to respect your trade. So your trades automatically are going to be a little bit more high probability. So do not go and just straight execute on supply zone. It's never a good idea. It's always better to look for a reaction, because that's your confirmation that that supply is going to be respected. It's way better. It's basically in retail for concepts, it's like you trading on a breakout. It's a little bit riskier, trading on a breakout, and it's safer to trade on breakout and retest, But at the same time, you're sometimes going to miss on trades when you're trading on breakout or retest. But again, at the end of the day, as traders, guys, you always need to be focused on protecting your capital. Again, everyone can trade, okay, but a few people are really good risk managers, and really few people can protect their capital. A lot of you guys are focusing on making money, making percentages, etc., and not focusing enough on your basic capital preservation. And in trading, your capital is everything. This is how you make money, with your capital. So, if you lose your capital, and it's easy to lose it, especially if you're, funded trader, For example, FTMO, you lose 10%, boom, you're out. They take your account. So you need to learn how to be a good risk manager, money manager, and really focus on protecting your capital. So it's always better to use supply and demand zones as a reaction, and if you see the price action is showing your reaction from that zone, then go ahead and open up a sell position in newly created supply right here. Okay, so premium discount is basically the best price that you can get involved. Don't try to sell here right here, guys. Okay, try to sell when price is in equilibrium or in premium. Okay, so another perfect example, guys, of this concept. So you have this ascending price action. What is ascending price action indicating to us? Weakness to the upside. Then we had impulse correction, impulse pattern, really beautiful momentum. As you guys can see, momentum here, and then a pullback here, momentum here, and then price action coming back correctively. Liquidity, building liquidity on the way up. We have our high here, we have our low here. We are drawing basically. You can use a flip tool and draw from this high all the way to this low, and you're gonna see this is 100%, this is null, this is 50%. Okay, and you're gonna know equilibrium is 50%. Above is equilibrium, or above is good to sell, and here it's not good to sell right here. Not that great, not that good. Corrective pullback to the upside, again indicating weakness in momentum to the upside, and then perfect execution to the downside. Really nice, really good. I like to get involved in this kind of entries when price is hitting equilibrium, and the price action, when price action is clean like this, when you have ascending impulse correction, impulse ascending again, it's beautiful to take these kind of trades on the equilibrium zone. I love them. So for example, when I would execute on equilibrium, and when I would be waiting for this second zone. So if momentum in this pullback is telling me a lot. So for example, if I have the same pattern, ascending price action, weakness to the upside, impulse correction, impulse pattern, and I have a little bit more aggressive pullback to the upside, well, I'm not going to focus on executing on equilibrium right here. Why? Because price action is coming aggressively to this order block. So I know it's most likely going to, take it out, because you're going against momentum. It's never a good idea to go against momentum. So in that case, it would be better to execute from this extreme right here. But if pullback is showing me that it doesn't have momentum to the upside, and it's a corrective pullback generating liquidity on the way up, I know that this order block is momentum order block, and on this order block I can have really good trades where I'm taking advantage of this momentum. Because again, guys, market moves like this: impulse, correction, impulse. What comes after? Impulse, correction, and again impulse. This is how market moves. Okay, so you're taking advantage of that most recent momentum. Okay, guys, here's another example. You have a high here, lower high here, lower low here. You have impulse, correction, impulse, and you have this corrective pullback, building liquidity on the way up, and you see this beautiful example of beautiful execution. Again, I told you earlier that it is better to use this zone as a reaction, okay, not execute straight on it. But in hybrid community, we already have predefined rules when are we doing that and when we're not doing that. Again, I cannot reveal everything. Okay, I cannot reveal how and when and why we do that. How do we trade? You need to check that with your strategy, back test a little bit and see, what is better for you, when are you going to execute straight from it, when you're going to look for reaction. But if you do not have clear strategy and you don't have clear rules for those things, it would be better to always wait for reaction. Okay. But in hybrid strategy, we have certain rules that we want to see, and this basically allows us to take advantage of this most recent momentum sometimes and not wait for reaction. So basically the same thing, guys. Go ahead and read everything, go ahead and study everything, find examples in the charts. So do not try to sell in this area here. Okay, this area here can be also used for buy, buy opportunities. So for example, something like this, when you have, you know, this couple of retraces in momentum, you see descending price action, then impulse to upside. You can even look for buys if you have imbalance in liquidity right here. For example, you can short-term buy to long-term sell. Okay, so watching on this momentum, you can, you know, start to buy here on the pullback and then take profits and then start to sell. A lot of traders do that. When you have impulse, momentum, impulse, they're looking for a pullback and they're buying in pullback. Okay, so do not try to sell here. It's really, really important. Always try to sell in equilibrium or in premium, because that way your trades are going to be more safer and you're always going to get involved in a better price. Okay, so I hope that's clear to you. And with that, guys, we are starting to talk about break of structure. Okay, so again, all of you are well aware of what break of structure is, but again, for the beginners, we are going to talk about it. So basically, you know, market, guys, moves like this. Okay, you have impulse, you have correction, you have impulse, and you're looking at this higher high, and basically when the price breaks this higher high, that's a break of structure, or BOSS. Okay, so BOSS stands for break of structure. Break of structure tells us a lot. So how do we break the high? How do we break the structure? If the price action is breaking highs impulsively, this usually indicates that we are most likely going to see another correction and another break of structure, and that trend is going to continue. But if we break structure with no momentum, with wicks, you know, etc., it usually indicates that price doesn't have momentum to continue to downside. So price action is telling you a lot, and you need to look and focus on those things. Okay, this is basically break of structure chart example, guys. You have impulse, you have correction, you have impulse. This is how market moves. Impulse, correction, impulse, correction, impulse, correction. This is how market moves. So again, you see it. We have the momentum, we had a pullback, we had a momentum. This is called break of structure when you break this high right here. So this is example of high probability break of structure, guys. So this is going to help you a lot, I'm sure of it, because, you know, a lot of you guys are using break of structure and change of character to enter your trades, you know, for continuation reversals, and knowing when the break of structure is impulsive and when it's good to take trades and when it's a bad thing to do will really help you a lot in your trading. So again, guys, you need to be well aware of those things. So as you guys can see, we have a high here. How does the price action break this high? Is this impulsive? This is impulsive. Look at this momentum. How we break this high with momentum. For example, this high, we didn't break it with momentum. You see, there is no momentum when we break the high. So this usually indicates that price doesn't have momentum. It's not that safe. It's risky to trade from this. And then, how do we break this high? Pretty good, pretty impulsively. How do we break this high right here? Also as well, okay, only one candle breakout, but again, we have a strong close. And then again, correction. Again, guys, impulse, correction, impulse, correction, impulse. So how do we break this high? Pretty impulsively. How do we break this high? Pretty impulsively. If you want to look for order block right here, if you want to look for order block right here and trade continuations with the trend, you would want to see that highs are taking impulsively. So with this momentum, you do not want to execute your trades when there is no momentum in the market, because momentum is everywhere, everything, guys. If price action is showing you momentum and trend is present, price is breaking the highs, retracing, showing you that pullback, and breaking the highs, retracing, breaking the highs, you want to get involved in those kind of trades, because it's the best thing that you can do, you know, executing trades when there's a trend. So this is going to help you a lot, you know, looking at how do we break the highs. If we break it with no momentum, with wicks, usually indicates correction and it's riskier to trade from that zones. So here we have a example of low probability break of structure. So this is basically weak break of structure. I mean, when I'm writing this, it usually means weak break of structure. So as you guys can see here, we had an impulse, correction, impulse. So why did I mark it as a weak break of structure here is because we have a lot of wicks. As you guys can see, momentum wise, this was a good momentum, but look at this. Every time that we're breaking the highs, we're leaving a wick, wick. So this is why I wrote that this is also weak breaker structure. Then we had a retrace and we came back and we barely break. How do we break these highs, guys? We made a wick and immediately retraced and immediately continued to downside. And then again, price is barely breaking above. And again, what is price action doing? Immediately after we break, retrace. And again, we break. Look at this high. We break it with just a wick and again a retrace. And again, we break it. And what we are leaving behind, this big wick. Then again, we are retracing and again, we are breaking and again, we are leaving a wick and again, we are retracing and again, we are leaving a wick. So this is indication that price doesn't have momentum to continue to the upside. So break of structure is all telling you a lot. How do we break this highs right here? If we break it with momentum, we know that the trend is present and momentum is present, and our trades are automatically going to be more high probability. And if we do not break with momentum, this indicates that we do not have momentum in the market and price action is most likely going to reverse. Okay, so we have weakness to the upside. This also can help you a lot when you enter trades. You know, if you have an entry here, sitting here, and price comes back like this to your entry, where you see, price is breaking highs impulsively, you already know your supply. Let's say if you want to sell here, you have, your pending order on supply here, for example, you know that your trade is going to be less high probability. Why? Because you're going against momentum. This is momentum. And if you have a supply zone here, you know that your supply zone is going to be more respected because you have this ascending price action, or you do not have momentum slowing down, and you can expect a possible reversal. So this is also can help you out when you're looking to trade, how price action is coming back to my entry. So right here, guys, we have change of character or touch. So this is basically a reversal. This is example for continuation pattern. Price just impulse, retrace, impulse. Going with a trend. And here, basically, when the trend is about to end, this is a change of character. When you have this couple of weak breaker structures, price indicating a standing price action, and then all of a sudden, boom, we break this low, this last low from that trend, uptrend, and then we have change of character. So this is example again of change of character, guys. Again, you can see this structure to the upside. How do we break the highs? No momentum in market. Even though you're looking at this bullish candle and this couple of bullish candle and this big bullish candle, maybe you can say, well, this is momentum. Well, actually, this is not momentum. And this is why I should learn price action. So we are not breaking these highs impulsively. Immediately after we break the highs, what is price action telling us? We immediately reject the highs, we make the wick and retrace. Immediately we break, we retrace. Immediately we break, immediately we retrace. Then all of a sudden, bam, strong momentum to the downside, momentum shift, change of character, and we are most likely going to continue to downside. Again, trading continuations, guys, is a little bit more safer because, when you're trying to catch a reversal, it's a little bit harder because price likes to give us fake outs a lot. So watch out for those liquidity sweeps. So again, guys, this is high probability change of character example. So as you guys can see, this is a price action going to the upside. Again, how do we break the highs? Not impulsively. How do we break the highs? Not impulsively. Maybe you think that this is momentum, but this is not momentum. Look at how many retraces we have in momentum. Then again, we're retracing. And then again, look at this. How do we break the highs? Barely. We are having one retrace, two retraces, wick, retrace. And then again, we're breaking the high. So we do not have momentum in this market. And then we have this boom, impulsive break of this previous low and change of character. So we have tons of trend line liquidity right here, guys. So when you see a standing price action that is indicating to you weakness to the upside, price is like tired to continue. It doesn't show you momentum to the upside. So it shows you weakness and it's slowing down. And then all of a sudden you see, boom, this shift to the downside. It usually indicates a reversal, and the price is most likely going to go ahead and take all of this liquidity right here that we had. So this is a low probability change of character example. So pretty much you have the same thing here, you know, price breaking above with no momentum, as you guys can see, retrace, immediately after we break, retraced, and then all of a sudden we start to break above with you know, momentum. This is momentum. This is considered as a good momentum. Then we had a pullback. Then again we had a momentum. In this momentum, this is not a good thing because we had a one retrace in momentum and we have left a big wick behind. But again, okay, so this is impulse, this is correction, this is impulse. So this is not weakness like this. This bit of price action is not showing you weakness. It's showing you actually momentum. Sorry guys. And then you had a breakout. You had this change of character, what I called weak change of character. So as you guys can see, look at this low. How do we break this low? Barely. We break it barely. We break it with wicks. And what we are doing, we are rejecting. We are immediately rejecting these lows. So what happens after we break the low is the question that you want to ask yourself. If we break with momentum and price closes with momentum, with strong candle close, this is an indication the price is most likely going to continue to the downside. And if you see the price is barely struggling to break this low, and immediately after we break the low, we are showing, you know, price is showing you rejection, wicks, you know, weakness. It's usually an indication that it's not safe to trade from that. And especially if the most recent price action was bullish right here, showing you impulse, correction, impulse. You know, so all of that combined, you can actually trade from this zone right here, from this demand. You know, but it's most likely going to test that demand and then boom, continue to the upside. And this is where, you know, a lot of traders are, you know, getting involved in, you know, those fake breakouts to the downside. They think price action is going to continue to the downside and then just boom. Especially if this happens. So let's say, for example, price reacts to this order block, continues to the upside, and then starts to react from this. And then all of a sudden, smart money traders are going to start selling. Retail traders also going to start selling on these head and shoulders. If price action starts to do this, you're going to see a head and shoulders, and then boom, price action is going to continue to the upside, trapping all of those traders. So really, really important thing, guys. Ask yourself a question. How do we break the high or how do we break the low? Do we have momentum or is price action showing us weakness? So here we are seeing a good example of fake change of character. And I'm just going to show you when not to get trapped, guys. Okay. So what can we see here on the left is price action going to the downside. We have this bearish structure. Then all of a sudden we start to, you know, descending a little bit. So in this momentum, in this bit of price action, we see a momentum. We're breaking these lows impulsively. We're breaking these lows impulsively. And then all of a sudden we start to, you know, show price action is showing us weakness in the market in form of this descending. Then all of a sudden we have change of character and we have a demand zone. A lot of traders are looking to get involved here or maybe here on continuations. So when is safe to get involved is when this high is taken. This is gonna be really, really more high probability. You know, it's gonna save you from a lot of, you know, bad trades if you're looking to get involved here in continuations. Okay, so catching here a reversal on this change of character or riding it until here. That's a pretty good thing. Remember, if you mark up the high here and mark up the low here, here's gonna be equilibrium. You know, so here what you're doing here, you're actually looking to buy. Here you're actually looking to sell, right? So you can focus here on short-term buys and long-term shorts. So this is where you can execute on this change of character, on this smaller descending breakout, shifting momentum. You can trade from this demand zone. And then here, a lot of traders are seeing when this happens, they see this momentum and they want to get involved in continuations. But again, it is safer to wait for this high to be taken, okay? And this bit of price action is also telling you a lot of things. If we have a supply zone here, and if we have a high here, and price action all of a sudden starts to show you weakness, we're breaking the highs, retracing, breaking the highs, retracing, and we have a reaction from this previous supply. And we have change of character, and this demand zone, last demand zone right here is failed, and we have a shift. This is a good sell setup, okay? This is a good sell setup. But again, this is going to be, for the people who are looking at this to buy on demand, are looking to get involved here because they think this was a descending, and all of a sudden price is reacting and going to the upside. They think they're gonna get involved here right now because the trend is ending. But in those type of cases, in a lot of situations, we have a fake out. So you're gonna have a descending price action, impulse to the upside, and you're gonna start looking for buys. You're gonna say, okay, price is finally reversing. I'm gonna execute right here. I want to buy because trend is ending, and I have confirmation the trend is ending. And then, boom! All of a sudden, this was a big fake out, and prices continue to put in new lower lows in the market. So look at all of these things. Did we take this high right here? Really, really important. Are we reacting from some supply and demand zones? Price action. What happens here is gonna tell you a lot. If you have weakness right here in form of this ascending, usually indicates a lot of things that most likely price is gonna continue to downside. And we have momentum here, and we break the highs. This is a good sign that reversal is really happening. So this is a chart example, guys. Okay, so you had a higher high here, higher low here. Sorry, lower low, lower high, low low. You're marking up your premium discount zones here. You can do it, and here you see price was having a little bit more of momentum right here, and then we have a weakness in momentum right here, change of character. We are even reacting from these demand zones, and boom, price is moving to the upside. And then all of a sudden, there are gonna be the traders who are gonna start looking to buy here because they're seeing this structure, bearish structure, and they're seeing this reaction. And they're thinking, okay, this is most likely going to be a reversal. So this is where, this trend to the downside is most likely going to end. And this is where I want to get involved right now because price is confirming to me that this descending structure is ending, and we have even change of character here, nice breakout. We even have a reaction, and price is showing me it's going to continue to the upside. This is where they get tricked, and this is where fake outs happen. Because again, guys, price is going to continue to the upside. We have liquidity right here. We have some imbalance right here. We have even liquidity right here. Price is going to tend to fill that liquidity, take that liquidity, and then continue basically induce all of these people who are trying to buy. And then we're going to have a reaction from the supply, and we're just going to continue to downside. We're just going to continue to make new lower lows. Price is just going to trap all of the traders. And here, in this bit of price action, there are going to be a lot of traders who are going to try to buy. Look at this momentum. Beautiful momentum to the upside. First of all, breakout traders. Breakout traders are going to start buying like crazy. And then you're going to have breakout and retest traders. So you're going to have traders who are trading this retrace. Then you're going to have supply and demand traders who are looking at this as a reversal. This is a reversal. This is a reaction. And this is impulse, correction, impulse. They're going to want to get involved in this demand. And price action, what is price action doing? It's reacting from this supply. It's going to the downside. It's breaking these lows impulsively. We have momentum. We have imbalance left behind. We have a strong close. We have shift. And then price action comes back, reacts to the store block, and continues to downside. So do not get faked out, guys, when you're looking at reversals. When you're looking at those longer descending price action, it's really important that you see this high getting taken. And that brings us in the next example. when you should be looking at to trades really that reversal, when you have this longer descending and you have this demand, this reaction, and then you want to see that momentum is present. So as you guys can see in this example, we do not have a weakness, we have momentum, and we have shift. Supply has failed and high is taken out. In these cases, your real change of character is going to be there. Okay, it's better to trade this because we have a lot of more confirmation that this is actually a reversal. This is actually a reversal, and here the trend is ending and the new trend is beginning. Because again, if you get involved here or here, you're gonna be a really good advantage if you catch that really trend reverse. Because market moves like that, again guys, you're gonna have price action making new lower lows in the market for a longer period of time, and you're gonna have price making new highs in the market. This is how market moves: down, up, sideways. Okay, and if you catch that reversal in the time, you can have really big risk reward trades, and you can really earn a nice profits because you caught that move once the trend has begun. You know, in the beginning of the trend, in the beginning of the move, you have caught a trade. So it's always better to wait for momentum when momentum is present, and when supply zone has failed, and when high is taken out. So I'm gonna show you the chart example right here, guys. So you have this lower low, you have this lower high, sorry, and you have this lower low. You have this descending price action, and then you have weakness here, as you guys can see, in form of this descending. Price has broken above, reacted, and then you have this ascending momentum or something like that, you know. And then you have supply zone right here, and then you have this high, major high, and then you see price reacted a little bit, you know, from this supply, and then boom, broke above with momentum. You see momentum is present, supply has taken out, high is taken out, and this is a good sign that momentum has changed, that we are not gonna see a bullish trend anymore. Price is most likely going to continue bullish. So this is the right time when you can say, you know, this is actually a reversal. I smell that the trend is near its end, and we are going to start a new trend, a new one. So supply zone failed, high taken out, momentum in the market. Look at this bullish, nice leg to the upside. We even left some liquidity right here. Price coming back correctively to our order block. Look at this, retraced one time, second time, third time, fourth time, fifth time. So descending price action indicating weakness to the downside, generating also liquidity on the way down, and then boom, we are continuing to the upside. So this is safer. So I know it's hard to catch a reversal trade. So the point of this lesson is, when you're looking at that descending structure and when you see a breakout to the upside, and then you want to get involved, you want to rush in because you think, okay, the trend has changed, I want to get involved. This is basically when to not get trapped, okay? And when there is more confirmations on what to do and when to really get involved in those type of trades. So it's always better to wait for that momentum, to wait for that failed supply and this high getting taken before you actually start to see, you know, that really trend change is about to happen. So yeah, go ahead guys and study this concept again. Go through the price action in detail and everything that we have done here for you guys. This is always, when you're looking at the reversals, this is always a better setup to execute than this right here, you know. So yeah, let's move on. And basically guys, we have example of continuation and reversal here. So again, we're having this descending price action, then we have weakness. Oops, I wrote it wrongly. This is weakness to the downside, guys, not to the upside, sorry. So we have this shifting momentum, weakness to the downside in form of this smaller descending, and then break up to the upside, change of character, reaction from demand. This is called a reversal setup, okay? When you have this first change of character, This is called a reversal setup. And then every next continuation that you have, impulse, correction, impulse, this is called continuation or break of structure. Okay, so there are two types of entries, reversals and continuations. Okay, reversal is a little bit harder to trade, you know, because you never know, is this going to be a fake out or not? But if you catch the trade here, you see, if you hold it through here, you're gonna win more money. You're gonna have a better risk reward than if you trade it here. But continuations are a little bit more better. Continuations are better to trade. Why? Because, you know, it's a little bit easier, you know, when market is moving to the upside already, putting you hard highs in the market. You know, you cannot go wrong with, you know, trading with the trend, trading with momentum. So continuations are a little bit safer and a little bit better to trade than reversals, because catching a reversal trade can be a little bit harder thing to do. But if you catch a reversal, it's going to be a really big risk reward trade, and if you catch a continuation, it's going to be a little bit less. Okay, so everything has its positive and negative things. So here, guys, is a chart example. Price going to the downside. You have this first change of character, not that clean, not that clear, you know, broke only with the wick, unfortunately. This high, but this we broke a little bit with momentum, then reacted, continued. So this is basically a reversal, and this is called continuation. When price is making this impulse, correction, impulse, this is a continuation. So basically two types of entries that you can trade. This is only showcasing, you know, the types of entries, so you know which one is a reversal, which one is a continuation. So first one that happens change of character, this is a reversal, and when, you know, there's another continuation, basically this is continuation or break of structure. So if you have problems with this, you can just turn on our indicator, and basically indicator is going to show you where change of character happened, where a break of structure happened, and that way you can study the charts, you know, with our indicator, and you're going to learn these concepts in no time. Okay, guys, so here I have in front of me a multi-time frame structure. So in this lesson, I'm going to explain to you why is it important also to look everything. Okay, so first of all, let me start with this. If you're trading and executing on multiple time frames, a factor of luck is going to be more present, okay? And your strategy is going to be a little more discretional. I know that a lot of people are telling you, you know, you should look for more time frames, more confluence, more confirmations, and that's a good thing, okay? This is basically our lesson right here, that, you know, looking at multiple time frames is a good thing, you know, because you're building confluence, you know, you're building confirmations, but at the same time, you know the thing, like more doesn't mean better, you know. Actually, you know, in this business, sometimes less is more. Believe me, less is more. So what can happen if you're actually trading on multiple time frames, and why do I say that your strategy is a little bit more discretional when you're looking at multiple time frames, is because first of all, factor of luck is going to be a little bit more present, you know, because one time you're going to execute on 4 hour time frame, let's say 4 hour time frame structure, daily supply, 1 hour breakout, 50 minutes order block, let's say. And then on a second trade, you're going to do something else, you know. So there is no trading on probabilities right there. That's what I don't like about, you know, executing on multiple time frames. You know, as I told you in the first part of the video, if you can, it would be better that you stick to one pair and one single time frame, you know. So it's gonna be better for you because you're gonna master that pair and you're gonna master that time frame. If you're trading on multiple time frames, again, the confluence can be a little bit, you know, different. So let's say, for example, you're gonna turn on the weekly time frame and you're gonna see that, you know, price is bearish. Then you're gonna turn on the daily time frame, you're gonna see that you have bullish setup. Then you're gonna go ahead and watch the 4-hour time frame. Again, you're gonna see bullish setup. Then you're gonna open a 1-hour time frame, 15-minute time frame is gonna be bear setup. So you see my point there. You know, this is telling you that, and this is telling you that, and this is telling you that, and then you're overwhelmed with all the informations, and then you do not know what to do. You know, what should I do now? What decision should I make now? And we all know, guys, if we are met with a lot of decisions as traders, we tend to be emotional. So this is why it is better to have less decisions when you're trading. And this is why your strategy should be made basically so it can reduce those decision-making process after you're trading. Your trading is automatically going to be less emotional and more logical if you do things that way. So, but again, I don't know how do you use your strategy, which strategy you're using. But again, guys, just a quick reminder, Hybrid strategy has it all. Okay, so we already have predefined rules for everything: execution, trade management, basically, you know, every little thing that you actually need. So for me, again, I have multi-time frame structure. This is basically it. You know, the blue line is higher time frame structure, and the other one is lower time frame. So you're gonna see that on when you turn on, let's say for example, daily time frame, you're gonna see that price actually is moving to the downside and putting new lows in the market. And then you're gonna turn on lower time frame, and you're gonna see that you have impulse correction. You have a breakout here. You have change of character. So there are traders who are looking to get involved here and buy, but they're not well aware that price action on the higher time frames is actually bearish. So there are traders who are going to look for buy opportunities in a bearish market. So this is why you should be looking at multiple time frames, because figure it like this. So higher time frames are more safer, and they're not how can I explain this, they're a little bit more analysis that you make on a higher time frame is going to be always stronger than analysis in a lower time frame. You know, your supply demand zones are going to be more respected on higher time frames than lower time frames. Structure is going to be more respected on higher time frames than lower time frames. All of the things are going to be more respected on higher time frames than lower time frames. Of course, we are not gonna, you know, execute our trades on daily time frame because we're not gonna have that big risk reward. We're gonna wait for days, you know, so we can see 2 candles. So we're going for lower time frames because we can actually trade more. You know, we can have a bigger risk reward trades, but on lower time frames, all of those concepts are not gonna be well respected as on higher time frames. This is why you should be looking at higher time frames. But again, guys, it's a little bit complicated because, you know, it can be a good thing for you, but also it can be a bad thing for you. You know, it's a little bit difficult because you should be looking at higher time frames. So you know where is the direction of the market. But what happens, you know, when you're looking at multiple time frames and one is telling you this, one is telling you that, you're going to get confused. So if you're a total beginner, you know, it's going to be really, really hard for you. So, yeah, just watch out for those things, you know. Do not try to get involved right here, you know, because you see, you know, lower time frame is bullish. Go ahead and check the higher time frames. In a lot of cases, you're going to see that this bullish move is actually just a pullback for continuation on the higher time frame. So basically, you're going to have impulse correction, okay, and what comes after impulse correction, and again impulse, and in lower time frames you're going to see impulse correction, impulse, and you're going to be like, okay, I want to get involved in this demand zone right here, but actually you're getting involved, you want to buy and you're getting involved in buy positions, but that's only a pullback for continuation to the downside on a higher time frame, you know. So watch out for those things, guys. Again, higher time frames are well more respected than the lower time frames, and basically when you're analyzing, you're starting with the higher time frames and you're moving lower. But just a heads up, you know, for beginners, it could be a little bit of a struggle to, you know, watch all the time frames. It can get a little bit messy because one is going to tell you that and that and that. So, you know, sometimes less is more in trading. So whatever fits you better. If you want, you know, you can go ahead and watch multiple time frames. If that is, you know, giving you more confirmations, go ahead and do that. You can do that. That's a good thing again. But again, at the same time, emotionally, it can be a little bit bad for you because, you know, as traders, we're tending to trade with emotions, not with logic. And we tend to look, you know, only what we want to see, focus on things we want to see and ignore those that we don't. So, you know, you're gonna go through all the time frames and you're gonna sometimes see only good things and ignore the bad things. So watch out for those things, guys. It can get a little bit messier. So if you do not want to have this problem, again, join Hybrid FX community, learn the strategy, and you're gonna see basically you're not gonna have this kind of problem. It's basically already done for you. We have solved it. So yeah, move on. Basically that's it, guys. You know, on chart example, market structure, overall market structure is bearish. As you guys can see, we're putting in lower lows in market. And all of these pullbacks on lower time frames, they're uptrends. And there are traders who are looking, let's say this is the daily time frame. Okay, this is daily time frame and you can clearly see it's bearish. You clearly see that we have impulse, pullback, impulse, pullback, impulse, pullback, impulse, pullback, impulse. This is how market moves. Impulse, pullback, impulse, impulse, correction, impulse, impulse, correction, impulse. And right now this is daily time frame, and let's say this on 1 hour time frame, this is uptrend, or on 50-minute time frame, this is an uptrend. And there are traders who are going to look at 50-minute time frame and they're gonna get involved here in buy opportunities, and they're ignoring the fact that this is just a pullback for a continuation. So watch out next time when you trade and check higher time frames so you see where is the direction of the market, what market is doing. Because again, guys, all of those concepts are well more respected on higher time frames than in lower time frames. So yeah, I hope you're not gonna get confused with all of this. You know, it can be a little bit of a struggle, I know, to look at this and that and this and that, and this is telling you this and that is telling you that. It can be a really struggle. So yeah, let's move on, guys. Basically, simple concept, nothing really, you know, really hard to learn. But when you're actually trading and when you're actually looking at multiple time frames, it can get a little bit more confusing. So again, we are here for you. If you need anything, if you have any questions, just go ahead and ask in the community, guys. And that's our another lesson, guys. Imbalance. I think that everyone knows what imbalance is. So imbalance is basically, you know, it's like a gap in the market. Okay, let's explain it this way, because everyone knows what's a gap in the market. So what happens when market makes a gap? Usually, you know, price action tends to fill that gap. And before we move on, I want to tell you that market doesn't need to fill that gap right away. You need to understand this. So market tends to fill the gap, but it doesn't need to fill it right away. Okay, because you see a lot of smart money traders, they're actually looking at imbalance. They're looking at imbalance, and imbalance is everything for them. Okay, it's everything for them. They're over focused by it. Okay, guys, and you need to understand that even if price makes an imbalance doesn't need to get filled right away. Sometimes weeks can pass, days and weeks can pass before that imbalance gets filled. Okay, it's basically buyers were too fast, and there were a lot of buyers and there were no sellers, and then all of a sudden you're gonna have boom, this massive push to the upside. Basically no sellers were in the market and only buyers, and when that happens, price usually tends to fill in that imbalance, or let's say that gap. Okay, so how you're looking and how you're spotting the imbalance is basically this big candle, and you're looking at the wicks. So you're looking at this wick on the right, on the right candle, and you're looking at this wick to the upside on the left candle. If these two wicks do not touch, this is imbalance. And if those two wicks touch each other, that's not imbalance. Basically, the easiest way how can you spot imbalance is that, looking at these wicks. So again, guys, go ahead and study this, everything what I have wrote, and if you have any questions, just go ahead and ask us. So this is a bullish imbalance chart example, guys. You see this was a clear uptrend to the upside, bullish momentum, and you see this week on the left and this week on the right do not touch each other. So this is imbalance. As well, right here, this week right here and this week right here do not touch each other. This is imbalance. But what happens with this week and this week? They almost touch each other. So this is not considered as imbalance. Okay. So let's look at this. Again, this week and this week, they do not touch each other. So this is considered as imbalance. But what happens here? This week and this week, they basically touch each other. So there is no imbalance here. What happens here? Do we have here imbalance? Yes, no? No. Why? Because this week and again, this week almost are touching each other. So when wicks touch each other, there is no imbalance. When wicks touch each other, there is no imbalance. Here wicks almost touch. So this is not considered as imbalance as well. So let's say, for example, this week and this week almost are touching. So this is also not considered as imbalance. And when we have gold example here, a huge gap in between two wicks. When you have a huge gap in between two wicks, you have imbalance. Pretty easy concept, okay? And basically concept is used for a lot of things. You can use imbalance for direction. So let's say you have, imbalance left behind, you have some kind of price action, you have maybe a trade. And then if you have a trade and let's say you want to buy and above you see that the price is left in balance, you have a little bit more confidence in your trade because you know that price action tends to fill that imbalance, and you know that if you execute your trade right there, the price is most likely going to head in your direction because there is imbalance left behind. So you can use it for an extra confidence when you're trading, when you're executing trades in form of like direction. Price is most likely going to tend to fill in that gap, to fill in that imbalance. So if I execute my trade with that direction, I'm gonna have more confirmations and more confidence in terms of direction. And another thing is maybe let's say you want to sell, you want to open a sell position, and above your sell you have imbalance. That's a little bit of negative confidence because above that zone that you're selling you have imbalance, and price is pulling back to your block. Let's say, for example, you want to short and you have imbalance above. It's a little bit of negative confidence because, right above your zone, there is imbalance, and price action again tends to fill that gap, to fill that imbalance. And then it's most likely going to take your stop loss and then fill that imbalance. So basically you can use it as a negative or good confidence. Basically whatever you're executing your trades, you know based on imbalance, you're gonna know if your trade is higher probability or not higher probability, etc. I want to tell you that you should not be again over focused by imbalance because smart money traders, especially smart money traders, are really over focusing on imbalance and liquidity as well. And you need to understand that yes, imbalance tends to get filled as a gap. A gap also gets filled in a majority of time. But again, it doesn't need to get filled right away. Okay, so you need to understand that sometimes days and weeks can pass before that happens. So there are traders who are gonna see imbalance left behind, and they're gonna see a good opportunity to buy because they have a direction. They have a good direction, and there's imbalance left behind. And then they're gonna trade some aggressive setups because they have extra confidence because there is imbalance. Do not do that to yourself. So they're gonna see imbalance and they're gonna be like, okay, look at this direction. I'm gonna open the sell here because market left imbalance down below, and I know that I have a higher success rate of this trade passing because, you know, imbalance is down and I'm trading with direction, you know, I'm trading, you know, that market fills that imbalance. Do not do that to yourself. Again, look for other confluences. Don't just do this. I see a lot of people doing this because they're over focused on imbalance. Also, when you have a trade, for example, you have like 6 confluences that the trade is good to take, and then you have one negative one, and that's imbalance above your entry. Are you still gonna take that trade or not? For me, I'm gonna take that bet. Why? Because I have 6 positive confluences and only one negative one. For me, that's perfectly fine. That's perfectly good because I have only one. I consider that a high probability trade. And there are traders who are not going to execute because there is imbalance above their zone. And imbalance, again, guys, doesn't need to get filled right away. I'm executing momentum. So price action can respect my entry, continue in my favor, and then after I win some percentages, after, you know, price moves for I don't know how many number of pips, then we can see a weakness, and then after a week maybe price is gonna feel that imbalance. So my point is basically really do not be over focusing on imbalance, guys, because imbalance is not everything. Yes, when you see imbalance, price tends to feel that imbalance. It basically acts like a gap in the market, but it doesn't need to get filled right away. Okay, guys? So again, guys, for more information, for more chart work, I'm just going right here to the PDF. You know, I'm not showcasing all of these examples on the charts. I do that 3 times a week, basically, when I'm recording videos for hybrid community. So if you want to see me do chart work and explain all of those concepts, basically the hybrid FX course is all about that. I'm taking imbalance, I'm opening charts, and I'm showing you all the examples. Trades that I had, trades that have passed, that have failed. Why did that happen? Why did everything explained in more details in hybrid trading FX community? So I'm opening my charts and doing everything with that. Here I'm just explaining you like on the PDF. So, you know, it's a little bit of less what we do in hybrid. So yeah, that's pretty much it. You have imbalance, bearish imbalance right here, guys. Basically the same thing. You know, go ahead, open it up and study it. Basically the same thing. And this is the liquidity concepts. And I want to stop here, guys. And I want to leave liquidity for the next video because we do not have a lot to go through. But I think liquidity and another concept that we have down below should be broken down in the next video. So yeah, that's basically it for this one, guys. Hope you liked it. Hope you enjoyed it. Hope you learned something new. Again, guys, if you have any kind of questions, feel free to ask them. We are here to answer all of them and help you out with anything that you need. So yeah, that's pretty much it, guys. Shortly we're gonna continue with the second video, and yeah, wish everyone a good day, and yeah, see you in the next one.